Good afternoon, everyone. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. Welcome to this week's Mortgage Minute. Uh, Appreciate you watching the show. Interesting week. I'll go ahead and comment on my. Jeff likes me to comment on, give you a sports report. My Angels are fading, so that's kind of sad to see. I was hoping after the All-Star break we would make a run, but unfortunately, as I said, they're fading. And then this week's been kind of a sad week as to celebrity news. They say how celebrities, when they pass away, that tends to happen in threes, and that's happening this week actually, with the passing of Ozzy Osbourne from Black Sabbath, and then of course this morning Hulk Hogan passed away unexpectedly. I'm not a fan, but he's a colorful character certainly. So that was a surprise. And then a musician that I know, well known, Chuck Mangione, passed away this week too. So there you go. We have a sad week of celebrity passings, three of them. So that's sad to see, sad to hear. Weather-wise, out here in the Coachella Valley, Palm Springs area, we're continue to enjoy sort of below normal temperatures. So we're thankful for that. We'll see how it plays out going into August. August usually, as you know, is tends to be the hottest month of the year, not just here, but most other places. So with that, let's go ahead and get right into what's going on in the mortgage and bond markets. First, we'll pull up our rate grid. um, you know, I keep saying I'm a broken record. There's just not been much change in mortgage rates. They continue to be holding very steady in the on the conventional conforming side in the low to mid sixes. There you see the temporary buy downs, both 3.21, 2.1 are in the 3.5, 4.5 first year rates. 30-year fixed conforming loan for good credit score and decent down payment size, actually down to 6 3/8. FHA actually broke back through 6 at 5 7/8 now. VA at 6, and those equity loans continue to look pretty good, as well as the 15-year fixed conforming loan just above 5.5%. So that kind of stability should be good news for those who have been waiting as it relates to maybe buying a house. Now, I know you've been waiting for maybe rates to go to the twos or threes, which we keep saying that's not going to happen. Fours and fives actually are not going to happen anytime soon. In fact, Fannie Mae released a new forecast for conforming mortgage rates for the balance of 25 and 26. And again, they're forecasting low sixes at the end of this year and hitting six even at the end of 26. So embrace these rates, realize that we're in a very stable environment, at least so far this year, with mortgage rates. And you combine that with what has been a case of increasing inventory in many markets, and the fact that sellers are having to adjust their list prices more often. That gives prospective buyers opportunities to take advantage of that and negotiate some concessions, and then in doing so get those seller credit dollars and apply it toward the financing so that you can get some very good interest rates on your loan when you're purchasing a home. So keep that in mind. Jeff's going to pull up the 10-year bond chart, and there you see it. Now again, this is a chart that runs 5 days from last Friday to today. You do see that dip from as it started to slide down Monday, Tuesday. You do see that dip, which actually is more Tuesday, late Tuesday, early Wednesday. That's that, Jeff has this theory that Wednesday is the day mortgage rates or the bond yields dip, kind of close to that. But then, of course, you see it kind of inching back up to today, where we're at currently at 4.4. If you really look at this grid closely, the scale of the yield has been kind of expanded to make it look like these are bigger moves than they really have been. We've been really kind of in a 10-year bond yield level of about 430 to 450. That's a pretty narrow range. And again, that underscores why mortgage rates have continued to be pretty stable, not just the past few weeks, but going all the way back to earlier this year. So we'll see how it plays out. Let me go ahead and show you or talk about a few things that are going on in the financial markets. We didn't have a very heavy calendar in terms of economic data, very light, in fact. But I thought I would share with you a few numbers that I think are kind of interesting. This week we had the leading economic indicators come out. That's actually an index that is published by the what's called the Conference Board. That's basically an economic think tank, and the leading economic indicators in June were actually down 0.3% after being flat in May. And based on now, the Conference Board was not predicting a recession with these numbers, but yet are suggesting or predicting that our GDP growth for the year 2025 in total will be about 1.6%. That's an interesting prediction because I'll remind you that, and I've mentioned this before, the Atlanta Fed is predicting that second quarter GDP in the US is going to come out at 3.8%. That's very strong when you consider in the first quarter, the GDP growth in the US was actually minus 0.5%. So if the Fed, the Atlanta Fed, proves to be accurate in their prediction for second quarter, for the Conference Board prediction to be accurate, that would imply the third and fourth quarter GDP is going to have to average about 1.5% per quarter, which is kind of odd when you consider if we do end up with a 3.8% increase in GDP second quarter, to then drop to 1.5 for the next two quarters, that's a pretty strong drop. So again, I think this is an undercurrent of this continued anticipation of the tariff policy, the tariff wars, whatever you want to call it, having a negative impact on the economy, where people are going to get laid off and manufacturers are going to slow down, and we can start to see some contraction in the economy. I'm not so convinced of that. We'll see how it plays out, but that, I think, is underscoring where those predictions are coming from. This week, the only other news of consequence in terms of economic data, existing home sales came out at 3.93 million in June. That's down from a little over 4 million in May. It's interesting, the media grabbed hold of that as an indication that existing home sales are getting very weak again. But again, the variation from month to month is just not that great. 3.93 million versus 4.04 million. That's not a huge difference. And although, yes, overall the existing home sales are still running at a pace that we haven't seen this low since about 2009. New home sales are forecast to be in at 645,000 in June, up from 623,000 in May. A lot of negative news stories about home builders and their confidence in terms of the market going forward. They're having a tougher time getting homes sold, but that's also why home builders in particular, I keep saying it, they're very aggressive about using financing concessions to their buyers, rate buy downs, both permanent and temporary, money for closing costs, putting all that together to help spur those sales. So yeah, they did have an increase in sales over May. Their margins probably got squeezed with all those incentives, but again, builders are very focused on moving the inventory and moving ahead. And sometimes we don't see that in the resale markets as I think we should. And then lastly, coming out tomorrow, durable goods orders, that'll be on Friday. And that's going to be an interesting number because it's forecast to be minus 11.1 in June after being up 16.4% in May. Well, that's an interesting forecast for June because, of course, June is still part of the second quarter, right? If we had 11.5% reduction in durable goods orders in June, that certainly wouldn't help support that 3.8% increase in GDP that the Atlanta Fed is predicting. So again, you see these examples of economic data points that are kind of conflicting with each other. So it's hard to kind of separate out the truth from fiction as to what the numbers are actually going to be. So we'll see what happens with that number tomorrow. And remember, next week, going to be a very interesting week for a couple reasons. Next week is the Fed meetings, Tuesday and Wednesday. It's pretty much off the table that we'll have a reduction in the Fed funds rate, despite the pressure from the White House. Again, pretty much off the table. The futures markets are not expecting to see any reduction in the Fed funds rate in July. Now the prediction is the first cut we'll have will be in September, and it's probably going to be 0.25%. And then the other thing that does get released next, I think it's Wednesday, the 30th, will be that second quarter GDP number. So stand by for that. We'll see if the Atlanta Fed turns out to be accurate with their prediction. I suspect that they're going to be pretty close. So we'll see how that plays out. So with that, Jeff's going to get on here so we can talk a little bit more about homeowners who've been, sitting on the sidelines, deciding whether or not they want to sell, waiting for an opportunity to sell. And we're going to talk a little bit about whether or not they need to sell and what other options they're going to have.
Hey, Art.
Hi, Jeff.
So, yeah, that was a tough week for celebrities. I didn't realize Chuck Mangione had passed this week. I did see the one with Hulk Hogan this morning, and it was like, wow, what is going on? I didn't realize they were coming in batches. That's sad to hear.
It is, and Chuck Mangione in particular, I've always liked him, and I consider him sort of similar to, you may remember this name, Herb Alpert.
Oh yeah.
They both, play the horn, and Herb Alpert's an amazing guy. I mean, he's in his 90s and he's still playing, and he can still play good. So yeah, well, but it's always sad to see, especially like in my case, maybe yours too. When I was growing up, Ozzy Osbourne, Black Sabbath, they were big.
Yeah.
And, I'll admit I was a fan. You might not think that, but I had all the albums, and yeah, it was really shocking. I mean, he just had that big concert in Birmingham, England, on July 5th.
Yeah.
Yeah, he had to, stay in a chair, but otherwise he did a pretty darn good job from the clips I saw. And my understanding is that this was not expected. The family thought he was still going to be around a long time despite his health challenges. So yeah, very sad to see.
Yeah. Well, and then your Angels are doing okay, but they're slipping just a little bit, I guess.
Yeah, they're just going to be in the doldrums and be plus or minus 500 for the balance of the year, I'm afraid. And it's sad to see in terms of their marquee player, Mike Trout. He's just not who he was. I mean, he's still just playing DH. He's hitting some homers and so forth, but he's our current generation. I think Ken Griffey Jr. Ken Griffey was supposed to be maybe the monster player of all time, and in his early part of his career, he was well on his way.
Yeah,
and he got sidelined with a bunch of injuries, and he just really never recovered from that. And I think the last 5 years for Mike Trout, it's kind of a similar story. And I don't know. I'm just not very hopeful that he's going to come back to what he used to be. I think he slowed down a bit. What I'm hearing is pitchers are just throwing fastballs at him like crazy, and he's striking out a lot. So
wow.
I think he's lost a little bit of the bat speed there. So it's unfortunate to see.
I think it's a pretty heavy burden when you try to put everything on one guy's shoulder to make your team. That's pretty tough.
Yep.
What do they call that? The franchise player.
Yeah, and he always has been, right? But, they have a pretty good core group of young players, and I think what's going to happen, the trade deadline's coming up next week. I have a feeling the Angels are going to be pretty quiet on that front, and I think they're going to pretty much keep the core of their team, and I think they have some pretty good possibilities for 2026 if they can keep this core bunch of young players that they have. And, of course, maybe Trout might still come around in 26. We'll have to wait and see.
Well, one other thing before we jump into today's topics, I read something this morning, and then I watched a short video on this about experts. And specifically, the experts have been telling us that, we're going to see these tariff wars drive, our prices through the roof. We're going to see inflation out of control. We hear the Fed is always, basing on what could happen, but what's not happening. There's no data to show that, hey, things are out of control. Is it just, how do we deal with this, Art? I mean, you pointed out how stable the rates have been, and even on the 10-year, how, we talked about it before we came on air. It's like, it's been in this really tight range for a long time, months and months and months.
Yeah, exactly. And I think the thing about it is, first of all, we say it all the time, right, Jeff? I mean, you got to really be careful of the headlines, for one. I spent a lot of time looking at the financial pages of, online, whether it's Yahoo or CNBC and so forth. And, some of these headlines are just, they grab onto such a slight change in some of these numbers and start, the headlines make it seem like, the world's falling apart, because you had a 1 tick increase in the CPI or something, when overall, when you really look at it, it's not that bad. I mean, we are well off the highs of a couple of years ago in the inflation rate. We're a lot closer to the target than not. And the bond market, I think, initially reacted very badly to that tariff announcement that the administration did a couple of months ago. What did they call it? Freedom Day or something? I forget what they called it, but
Liberation.
the bond market just crashed and the bond yield shot up quite a bit. And then there was all these predictions that we were going to hit a 5% bond yield, soon, like certainly later this year or by the end of the year. Well, we haven't really gotten past 4.5, and we've probably been for most of the year well below that. And that's a good thing. I mean, that to me, it's all about the glass is half full, glass is half empty. So I just keep telling everybody, take it all with a grain of salt. This notion, and I still see comments in headlines and in articles about we're in a near 7% market on mortgage rates. And yeah, that's why people are not buying homes, is because of the high mortgage rates. Well, I am sorry. Mortgage rates are getting a bad rap. Those articles, those headlines need to say people aren't buying homes because the home price is too high, not because the mortgage rate is too high. And that's a subtle, splitting of the hairs, but I think it's an important one. It's the home price that's a bigger problem, in my opinion, than the mortgage rate.
Yeah, it feels like we as the consumers and the media have taken an exception and made it the rule and based everything across from that. The extremely low rates that we've had that, I mean, I remember being told when I would look at homes as an investor, and then somebody'd have a 3% loan and we were at 8 or 9% at the time. And you're thinking, will that ever happen again? And everybody say, it'll never happen again. Well, it did, but it was a total another generation. So if you're waiting for that, I agree with what you're saying, is the stability is there. It's the home prices. Well, with that, I think that works really well in today's topic, which is, there's a lot of people out there who have homes and their equity has grown, but maybe, some conditions have changed. Like, hey, I've had my house for 10 years. I really wish I had a new house because the kitchen or the bathroom or whatever. But they have those low rates and they're a little bit gun shy. So they're thinking, should I move? Should I refinance? What should I do? And so that's what I kind of want to talk to you about today.
Yeah, I think a very good subject to talk about for sure, because I think there's a lot of homeowners that are in that situation. So they have that dilemma about what to do. Do they stay or do they sell and move on? And I think what we want to maybe talk a little bit about is they have more options than just selling, if they have more of a need with their housing than what they own currently.
Yeah, and I think one of us, let's talk about some of the ideas when you have the equity. And I know you've talked about, tapping into equity. You did last week for investors, but now I want to talk about it for homeowners, not investors, but really what can they do? So the first thing is tapping home equity without selling. And it says, more California homeowners are turning to equity financing as a smart way to stay put while still assessing the cash they need, whether it's for renovations, debt consolidation, or helping adult children buy their first home. What do you think about that?
Well, first thing I would say on this bullet point is that last part of that clause is to help adult children get off the couch and buy their first home. But no, seriously, that's the decision point that a lot of homeowners are at. And let me tell you something, because I looked up some stats that are pretty darn remarkable. In terms of equity lending, in the first quarter of 25, equity lending, or what they called HELOC and equity loan withdrawals, were surged, as the media calls it, 25 to nearly 25 billion.
Wow.
That's a pretty strong number when you consider most equity loans aren't as big as a first mortgage, right? They're usually smaller amount, 50, 100,000, maybe a couple 100,000. So that's a pretty remarkable increase. And in fact, it's the highest first quarter volume of equity lending since 2008.
Wow.
Of course, we all remember 2008 when people were pulling money. In fact, that's what's interesting about our current environment versus back right before the Great Recession from the real estate market crash, is back in the early 2000s, people didn't hesitate to tap into their equity. In fact, they were doing it continually, repeatedly. In fact, in the industry, we would joke about how some homeowners were using their homes as an ATM machine.
Mm.
And they would pull out more equity like every 6 months or a year because home prices kept going up so quickly. And in fact, for the second quarter, it's predicted that home equity loan volume is going to double to 50 billion.
Wow.
Now, again, that sounds like a very big number, but at the same time, currently tappable equity in the U.S. residential housing stock is at about $11 trillion.
Wow.
And so when you look at these 25 billion in first quarter and second quarter of 25, it may get to 50 billion in home equity lending. Well, when you compare that to the available tappable equity of 11 trillion, even though that loan volume, which is a bright spot in the mortgage industry compared to first mortgages, be it purchases or refis, that amount, 25 billion, 50 billion, is minuscule compared to the amount of available equity that can be tapped. So what that tells you is a lot of these homeowners are stuck in this sell or not sell, and they're not thinking enough about the other option of don't sell and tap into that equity, because the current number of people who are doing that is pretty darn small compared to what is available to them. And that's really what I think they need to realize, is that, if they want to sell because, yeah, their house is too small, they've got a kitchen that's outdated, they want to add another room or something, they have another option. And I think more and more people need to think about that and explore the ways that they can tap into that equity. And that's where we can help.
I love it. Well, I think about this and I'm thinking, is there how is the information you shared there? What's the mindset, do you think, of the average homeowner today versus 2008? Like you said, it hasn't been that big since 2008, but it's a different climate, isn't it?
Well, it really is. I think, back in 2008, I can remember that, we fell into the trap of kind of a herd mentality. The old, there's a concept, it's called the madness of crowds. And back then, rates were relatively good. I mean, they weren't 2 or 3, but they're relatively good. But, it was so easy to get mortgages to buy homes that fueled an unprecedented rise in home values that was very significant and very quick. And so people basically just got on the bandwagon to think that, oh, wow, every year our home price or home value is going up 10, 15, 20%. And so when they would see that, they had, I think, they were less cautious about, tapping into that equity and using it for a variety of purposes. In many cases, not very smart decisions with that equity. So I think that's a fundamental difference, because see, now most folks, whether it's prospective buyers or existing homeowners, I think now the focus, or maybe the concern, is more of, well, rates doubled from the pandemic to now. That surely has to mean that home prices are going to moderate or maybe even fall, because less people are able to afford to buy a home. And so as a consequence, I think for the homeowner side of the equation, maybe there's a little bit of worry that, hey, if I tap into my equity, what then if after I do that, my home value falls instead of going up further, and then I'm going to end up underwater. Now, I think we are very, very far away from that when you consider how much tappable equity there is. And by the way, folks, tappable equity in the industry is defined as the amount of equity up to 80% of the value of the housing stock. So even with that 11 trillion of tappable equity, there's still that remaining 20% of equity that we're not even talking about.
Wow.
So I think that's kind of what's going on in the psyche of the current, either the home buying side of the public or the homeowner side of the public. I think they haven't bought into the fact that home values are just going to keep going up and up and up, although they have been, but not at the rate that they did back in the early 2000s. So I think that's probably the difference.
I'm curious when it comes to getting financing for a home for your, let's say your first home or another home versus getting or not refinancing, but for a home equity line of credit. Is one easier or harder than the other to attain?
Well, actually, in a lot of cases, a lot of situations, getting the HELOC can be more difficult.
Hmm.
Um, and primarily the reason for that is what I would call the core HELOC product in the industry. It's a variable rate loan, and it's variable because it's tied to prime. The prime rate, the Wall Street Journal prime rate, they call it. Now that rate is a short-term rate, and therefore it directly is correlated to the Fed funds rate. And so a variable rate HELOC tied to prime, it's called variable because the rate can change whenever the Fed funds rate changes. Well, from the underwriting perspective, after the lessons we learned in before 2008, the homeowner, the borrower on a variable rate HELOC is not going to be qualified at the initial rate on the loan. That's because it's variable. The rate could go up. So what lenders now do, what the industry now does to maintain focus on the ability to repay, which means being able to qualify based on debt ratio, but then also in a variable rate loan situation to take into account the potential for increases in the rate, not a decrease, you are typically going to be subjected to a formula that says, okay, I'm getting a HELOC at 8 3/4. In fact, I sent out a worksheet this morning for someone on a rental property. They wanted a HELOC for $500,000.
Wow.
And I was able to price it out and offer them an 8 3/4% rate, which is very good for a HELOC on a rental property, especially for that loan amount. But if the person decides to go forward with it, we're not going to qualify them, and we're not going to calculate the debt ratio based on 8.75. We're going to calculate it based on the index plus margin, which in this case is prime plus 1 1/4. That's how you get to 8 3/4, plus 2%.
Wow.
So the borrower is going to have to be qualified at an assumed rate of 10.75, and based on not interest only, which is the minimum payment available on that HELOC, but fully amortized. So when you take into account a fully amortized 30-year payment based on a rate 2% higher than the starting rate you're going to get, it's tougher to qualify. You have a greater risk that you're going to miss based on debt ratio. And so that can be a real issue in a lot of cases. And we run into that actually quite a bit more often with older homeowners who maybe have a little bit different income level than they did before, maybe relying more on retirement income. And they're thinking, oh, I got a ton of equity. Getting a HELOC is going to be easy because I have an 800 credit score and I've got 70% of my home value is equity, so I should get the loan just because of that. Well, no. Ability to repay says we still got to make sure you qualify on debt ratio. So we got to look at your income, look what the payment is, and then if the qualifying payment is inflated on purpose to make sure you don't default, then whoops, suddenly your debt ratio is 55, you can't get approved. So we do run into that more often, and that's why a HELOC oftentimes can be harder to qualify for than a traditional fixed rate mortgage. Now, that being said, we have a unique product, which is a HELOC, but it's called a fixed line HELOC, meaning that the loan, when you get it, you get a rate that's fixed. It's not tied to the prime rate. It's a traditional fixed rate loan. Most of the ones we do are on a 20-year term. And because it's fixed on a 20-year term, you do get to qualify at the start rate because it's never going to change. So you're not qualified at 10 3/4. You're going to qualify at 8.5 or maybe less. I sent out a worksheet last week on one of these where the rate was 7.5.
Wow.
So we do have a solution to that qualifying problem with HELOCs. In the appropriate situation, it can make a big difference. Then on the other hand, because we got to have a lot of hands here, a variable rate HELOC, if you can qualify, might be a good option only because of these predictions about where the Fed funds rate is going to go. Despite the fact that July reductions off the table, September, good bet it could go down 1/4, and then there's a bet that we'll have another quarter by the end of the year. Well, if you get a variable rate HELOC, And that happens, that prediction happens. If you get one now, well, by the end of the year, you may end up with a rate 0.5% lower than what you started with. So that could be a reason why a variable rate HELOC would be a good option.
Well, if I'm not mistaken, at the first of the year, if we went back and look at your HELOC and HE loans, they were up around 9 or 10%. And now I saw today when you were presenting that it's in the 7s. Is that correct?
That is correct in some circumstance. That's basically, those rates are going to be based on a good credit score, typically 760 to 780 or higher, loan to value or combined loan to value when you're added to your first mortgage at 60% or less. That's where you're really going to be able to capitalize on a very good rate. And in fact, by the way, particularly with HE loans. In fact, lately, HE loans, again, that's a fixed rate second mortgage. It's just like a first mortgage fixed rate, except it's a second. You don't get to do future draws or anything like that. You get a fixed rate loan, and when it closes, you get all the proceeds and you're done. You just start making payments. Those loans actually lately are offering better rates than a HELOC. So that's where you have to think through when we're talking about to sell or not to sell, what kind of equity financing you want to get depending on what you're going to use the money for. And we can get into that a little bit more, but the HE loans, actually, the increase in HE loan origination volume has been better than HELOCs because people are seeing a pretty good rate advantage for that fixed rate equity loan versus the variable rate HELOC.
Well, I'm hearing this more and more as I'll have dinner with friends or their younger children, and they're saying we're not moving, we're not selling what we have because when we went out looking around, we can't replace it for the price that we can afford. Right. So we're going to stay there. So they're talking about, this little shift from, hey, I'm selling to move to the next one, to leveraging the equity in their home and making it like their forever home. How do you hear that more and more often?
Quite often. In fact, that's the whole point is like if you go back to 2019 before the pandemic and look at home values and look at where they're at now, a home that was worth, $500,000 in 2019 is probably worth 850, maybe 900,000 now. That's an incredible jump in about 6 years, but that's what we've seen. But when you got that home, maybe in 2019 with 500,000, maybe you put 20% down. So you've got a $400,000 loan, and then you find out your current home, your same home now is worth 850, maybe 900. Well, how do you do? I mean, you've got now what, 400, 450,000, $500,000 of equity. And then you realize when you, like you said, when you go out and see what you can buy for 850, it's not the same house as what you got now, albeit your house now may need some, freshening up. It may need, have the kitchen redone or, what have you, or maybe you need to expand it because maybe you've got another child or two and so forth. So what we're trying to get folks to realize is you don't necessarily have to keep waiting for the right opportunity to sell. Realize that you have so much equity, you could probably take your current home and make it into something that is good or better than what you're seeing out in the marketplace. And even with taking out that additional equity in terms of a second mortgage, you're probably going to be better off than going out and buying something at current rates. And those improvements, depending on what they are, could add even more value to your home than what's already occurred from just the increase from 19 to now.
Well, is it safe to say or to think, hey, if I'm going to invest in anything and my home value has gone up 3 or 4 times my original value that I paid for it, is it safe to say taking some of that equity and investing in it to then improve it, bring it up to date, is not a bad investment?
No, in fact, I would argue it's a good investment. It's like the bullet point there says, shift from thinking about selling and shift to using your equity to leverage what you already have and create more value with the asset you already have. And there's other elements to that than just improving your current home. You could decide maybe your current home is fine. You feel like it still meets your needs. You're happy with it. You could look at get equity financing for maybe a little bit of cosmetic, dressing it up and, paint, whatever, and some other things, new flooring and so forth, without maybe adding square footage and those kind of things. The other thing to realize is that the equity loan option, if you decide not to sell, can benefit you from the standpoint of improving your current home, to further meet your needs or to further please you in terms of its appearance and its quality and so forth. But you may have enough equity where you can do some of that and then take the rest of that equity loan, whether it's a fixed rate loan or a HELOC, and then use it to focus on more wealth creation, like use it as a down payment to buy a rental property. And if you find the right rental property, you can find something that could end up cash flowing very well based on the loan amount you're going to need to buy it, using the equity from your existing primary home. And that way you've diversified your assets. You're going to have an opportunity to build more wealth by using your equity, not just to improve your current home, both in terms of its condition and value, but then also to create additional income stream from getting into the rental real estate market and generating more wealth that way, both in terms of potentially getting some positive cash flow at some point, as well as that property appreciating as well. So, and of course, then there's always that factor of getting the adult child off the couch and getting them into their first home. And maybe you do that with them. I read an article about a mortgage broker in Hawaii where, multi-generational home buying is very, very common. And of course, multi-generational households are more common there than here. And so sometimes you can have, create that kind of situation here with the equity that you've seen increase since you bought your home maybe 5, 6, 7 years ago.
Well, the next thing I want to ask you about, and then we'll probably start wrapping it up, is your friend Dave Ramsey, who says, hey, if you have to pay off debt, look at those high interest credit cards and other debt that have high interest. And, when you're talking about, even if it's 8%, isn't that a lot better than a credit card and then using that equity to offset and the high interest credit card that, quite frankly, would probably, by the time you borrow the money and pay off the other loans, wouldn't it almost be a break even, or even you're ahead now as far as monthly outgo?
Absolutely. In fact, I've been in discussions with a particular homeowner here out in the desert for about 3 weeks now. They're struggling with this decision point because they have an existing first mortgage with a very good rate, but they have a tremendous amount of debt. And they're struggling with what to do about it. And it's affected their credit scores by a considerable amount. And so they're stuck on this, gosh, I don't want to give up my 3% mortgage, even though I showed them that, look, if you take out, and in this case, we're not talking to them about a second mortgage because, frankly, their credit scores have gone down too low to the point where they can't get an equity loan. They don't qualify and score. But I can get them a first mortgage. In fact, we're actually, believe it or not, talking about an FHA, where I can get them still a rate at 6.5% when they have a 580 credit score.
Wow.
Now, they're struggling with, well, if I do that, I'm going to give up my 3% mortgage. But I'm trying to show them that when you tally up all the other debt they have, and I'm telling you, it's substantial, like 6-figure.
Wow.
I'm showing them that if they pursue this and, cut the cord, give up that low rate first, consolidate all that debt into a new first, they're going to save a substantial amount of monthly household cash flow, like by $2,000 a month.
Wow.
But, they've got friends, family, the brother-in-law in their ear telling them, you're crazy to give up that low first rate mortgage. Well, those folks have insufficient information to give any kind of advice that's worthwhile. And so, that's what I'm trying to get across to them. And this is an opportunity that they can get out from under this mountain of debt. I mean, they have literally 20 credit card accounts.
Wow.
So, they have to realize that they have this huge opportunity, but, and there's always a but, I'm also acting as their therapist, their counselor, because they have to realize that while this would be a tremendous relief financially for them to pursue this, they've got to commit to a major change in behavior. they cannot borrow consumer debt the way they have been again. Otherwise, they're going to completely undermine this opportunity to get rid of all that debt. Yes, their mortgage payment, their housing expense would go from $3,000 a month to $5,000 a month, which scares them, but it gets rid of all that other debt. So all total, dollar for dollar, when you compare the two situations, their current to the new one, they're much better off giving up that low rate and doing that refi. But once they do that, all those cards got to go into the trash, shred them, don't use them again, have one or two major credit cards, maybe a gasoline credit card, stop. You don't do anything more. You never apply for a department store credit card, none of that stuff. And if they do that, if you can commit to that change in behavior, it's a tremendous opportunity. And I think more and more people need to realize that and consider pursuing it. But again, be disciplined about it and don't get off track a second time after you make this kind of change, because it can be really life-changing if you can stick to that strategy.
Yeah, it sounds like the tough part there is it's almost like, AA. You have to then have the support system to say, you just can't finance your lifestyle like that anymore. You have to live within your means. If you do, If you have cash, pay for it. If you can't, you just don't do it.
Right.
But like you said, it could save them $2,000 a month, which that's pretty significant, Art.
It really is. Wow. It really is. But see, that's not the only way that people can use equity. And this gets into back to the concept that when I'm talking to homeowners about, is understanding what you're going to use your equity for. If you're going to use your equity for something that's more of a one-time event, like you want to build an ADU, again, whether to rent it out on your property or whether to get the adult child off the couch and in at least a separate structure on the property, or you want to remodel that kitchen, or you're going to remodel the kitchen and replace all your doors and windows. Again, something that's a specific project. That I think, is a factor in deciding what kind of equity loan you want to get. I think when it's a specific project, like, getting a second home, building an ADU, a major remodel of your home, a lot of times that would actually be, you're better off, and would call for, just get a fixed rate second mortgage, because you have a specific purpose in mind for what you're going to use the money for. It's pretty much going to be a one-time event. And once you get all that work done, or you buy that other property, you're done. Right now, the fixed rate second, the HELOAN, is a better option on rate. Now, if you need to pay off some credit card debt, like these other folks I was just referring to, and you maybe want to have a little bit of a rainy day fund, that HELOC may be a better option. But make sure that you're disciplined enough not to reincur that consumer debt after you do that, and then you're going to be better off. And so that's why, when you look at those kind of scenarios and that last bullet point, equity financing doesn't mean it's not going to bust you. It's not going to take you into bankruptcy. If you understand, first of all, if you know exactly how you're going to use the money, and then understand what each option provides you, and then be disciplined to stick to either one of those strategies, then that really is a myth. You're going to be fine getting that second mortgage, tapping into that equity. It's not going to get you off track financially if you're going to change your behavior, focus on your strategy, focus on the outcome, and stick with it.
Well, I'll share just as a closing in my piece is this is exactly what my wife and I did. We thought about selling our home, and we could have sold it fairly easily. But then we started looking and investigating and said, geez, we really, for what we can buy, that means we have to really downsize. And through your help and counseling, we said, well, why don't we just, pull some equity out of our home? We were fortunate we had a pretty sizable amount.
Right.
And we just remodeled our kitchen and painted the house and put a new roof on it. And now it feels new again. And my wife loves it again, which makes my life easier. So it is a good play. It just makes so much sense. And at the same time, there was not any real, I'm going to say, speculation in saying, well, what if we took that money and I put it in some kind of a stock or an investment? I don't know about that, but I do know about my home and the location and how the environment is, that it's a pretty sound investment.
Exactly right. And I think more and more homeowners need to understand that can be the outcome. That home you're living in, where you feel suddenly like you're tired of it, and you're not sure it meets your needs, and you really feel like you want to move, but you're very unhappy emotionally because you don't like what you see out there in terms of opportunities to buy because the price is a lot higher than you expected and you don't get as much of a house that maybe what you have now, you got to realize that, deciding not to sell and using equity financing in a very strategic and disciplined way can suddenly take that home that you're tired of and you don't like anymore. And boom, next thing you know, well, it's like you got a facelift and now you're happy looking in the mirror again because you like what you see. Well, you can do that with your house too. Again, if you have a specific strategy, you stick to it and you're disciplined about it.
I love it. Well, Art, before we close up, any last messages or last thoughts on this piece about, if somebody had to, if they were in that crossroads of, well, should I sell? Should I use my equity? What should I do? Any last thoughts?
Well, yeah, call me. I joke about it, but a lot of my job involves just talking to people about their concerns, their needs, their wants, what their desires are, and helping them. And I can be a pretty good sounding board. I've been around a long time. I've been through lots and lots of scenarios. So I can be a resource where I can bring up things that maybe they hadn't thought about. I can address the concerns that they have in terms of the numbers and the financing options and what kind of outcomes that they can expect to get. So really, that's what it's all about. Call me. We'll just have a conversation. That's always how we start most of our loans anyway. The way I start most of my loans is having a conversation and see if I can help them get from where they're at now, where they're maybe not too happy, and get them somewhere where they're going to be a lot happier. And a lot of times that's going to mean not selling and buying. It's going to mean staying and taking advantage of these equity loan options and create something that's going to be fresh and new, even though overall it's still the same place they're living in. So,
well, Art, my last closing piece is this. When we sit down and talk to you, or anyone would sit down and talk to you, because you're so knowledgeable about the industry, you can see things that we had no idea of. I mean, I hear you talk about this in our meetings on Tuesday about situation of like, oh my gosh, I didn't even realize that exists. I said, is that new? Oh no, we've been doing it for years.
Right.
And I think that's the part that we as homeowners, consumers say, let me do what Art said, call, let's talk about it, because there may be a different solution you've never heard of that actually is just a perfect fit. So I really encourage you to call Art. Art, thank you so much. A great show. I'll turn it back over to you.
All right. Thanks, Jeff. Thank you, everyone, for watching and listening to this week's Mortgage Minute. I'm Art Alvarez with MortgageWorks, where we have the answers and they're on the house. Have a good weekend. Continue to enjoy this cooler than normal weather at this time of year. Hopefully we'll hang on to this for another week or so. It looks like we will. Hopefully that'll be the case where you're at too. In the meantime, again, have a very good weekend, and we'll see you next week on our next edition of the Mortgage Minute. So long. Take care.